Hello everyone, a very good morning, good afternoon, and good evening to all of you. This is your host Vaibhav for today's session of trading with the Visual Jforex. We are going to start the algorithm development using an interesting indicator. The name is EMA, which stands for Exponential Moving Average. This is a type of a moving average which gives you an idea of how things are moving for the underlying instrument, whether on average, on balance, the price is moving upward or whether the price is moving downward, or for that matter whether the price is moving sideways, that is it's simply consolidating in a narrow range. All these things can be gauged after looking at the charting, after the plotting of seeing the EMA as being a exponentially moving average, which is more weighted for the recent price action, is going to be responding much faster to the recent fluctuations in the price. If there is a high volatility situation, then the EMA is going to respond better in comparison to the SMA, which I introduced to you a couple of sessions back. So this is a kind of a modified SMA. There have been factors added to take into account the recent price action rather than looking at all the price action for the given time period in a same manner. More weight is going to be attached to the recent price data, recent price series from all the data points. Let us head to the J4F platform on which we will see how it works and what we can do to make the best use of it. You can add it simply by doing a quick search. If you type in EMA, there you get it, exponential moving average. There is a EMA line with the calculation period of 30. That means last 30 candles are being taken into consideration for the calculation of that particular candle period's EMA. In it, you can see that it responds quite sharply to any big price change. So that is what makes it interesting. On balance, you will see that the way it moves, it gives you a fair idea of how the underlying instrument is performing. If on balance the price is on the rise, then you will see the smooth upward moving graph of the EMA. If the price is in declining phase, then you will get this smoothly moving downward sloping line. But also there is one more factor, that if the price changes suddenly from one side to the another, it will take time to respond. Now here, if you take into account the last session's price data, you will see that the price of the Euro USD was moving upward slowly and steadily, and after a while it reached this phase close to 1.12, where it stabilized sort of, but still we had this EMA line moving upward because this average moving price, and we had this graph charting this price upward because earlier in the earlier period the price was on the downside, then there had been this sharp move on upper side, so it took time for it to adjust to this elevated price, and that is why it kept climbing all the way till this sudden drop in the price of the Euro USD. Only after there was a significant price drop, the plotting of the EMA started to reverse. So if you had traded anywhere close to this line, thinking that the upward price move is continuing, you would have ended up in loss. So there is one drawback. If there is sudden sharp move, it is going to take time to adjust to the undertone and respond accordingly. Here also you can see the same thing. It was moving sideways starting from the 15 GMT of 17 September. It kept moving sideways because there was no broad trend. There was no strong trend on either side, neither bullish nor bearish. But the volatility increased. Even in the face of increasing volatility, it kept moving sideways only with a slight tilt on the downside. And then there was this price drop. After that, there was this strong bounce again, and eventually it went on to rise. If you had adopted a buy on dips approach after this sharp move on the upside, you would have made money. But if you had adopted buy on dips approach earlier, then you would have lost money. So all these factors need to be kept in mind because, like any other indicator, no, this indicator, the EMA is also not perfect. It is going to respond to the price moves in a fairly impressive manner, but still it will also have its own difficulties. It will fail to read the price moves which are sharp, which are volatile, in which there is big price change in a short period of time. That kind of environment will keep creating challenges for the EMA to give you a fair idea of the trend. And if there is absence of trend and the range is high, if the volatility is high, even in that kind of environment you will find it challenging to trade using the EMA because the price will keep moving on both the sides of EMA, confusing you and the algorithm you are building using the EMA. So if you are planning to build a system, if you are planning to build the algorithm using these indicators, then you will have to study its pros, its cons, and suitably adopt your algorithm to work best in any circumstances. So I will try to help you in that quest. I will give you a give you a brief idea of its utility and what you can do to filter out some noise, the signals which keep occurring all the time. We are looking at the price series. Suppose if you started trading using the EMA with the classical interpretation of reading, if it is rising, then the momentum is bullish, and if it is in decline, then the momentum is bearish. You would have suffered loss somewhere around here. Then you would have made money using buy and dips approach all the way till 22nd of August. After that, maybe little bit of money, but then loss again, and then buy and dips approach. You would have made little bit of money. Then second time around, there was price drop, loss again, and then if you had adopted sell on rally approach, looking at this bearishness, you would have made money till 4th of September and then lost money again and then made money again these two times, then lost money again around this 6th of September and then sell on rally approach and made money again till 12th of September, and after that here you would have suffered loss because of change in trend and then made money again till the 18th of September using buy and dips approach. Then there are a couple of trades which would have ended up in losing mana to come back again and trade with this Euro USD in a buy and dip approach. You would have made money, then again lost money, then made money, lost money. So here, what I am trying to give you the sense of is that the trades will keep happening whether you adopt a simple approach like buy on dips and sell on rally using the classical interpretation of these indicators. When it is rising, then the momentum is bullish, and if it is declining, then the momentum is bearish. So if you simply use this classical formula and design the algorithm, as I explained to you, there are going to be phases where you will be making money, then there are going to be phases when you will be losing money. It's part of the game, not all the time the money can be made. There are days when you rake in the mullah, then there are days when you lose your account balance, and all our endeavor should be to try to enlarge our winning phase and try to minimize our losing phase. For that, as I explained to you, there are some key factors which we have to keep in mind and design the algorithm accordingly. There are three distinct phases in the market, and for keeping the probability of getting the trend and trade right, we need to be first able to identify the phase of the market and trade accordingly. There are multiple factors like volatility, like the trend, etc. And for that, you will have to rely on some some formulation which is going to incorporate all these factors. For the EMA, I feel adopting a calculation period of 24 is going to be just fine. Here, we will take into account its high price and low price to get the sense of volatility. This is for the high price. Let me add one more on this of low price. Now, in it you can see that when there is sharp move, you will have these adjustments taking place. Sometimes you will have high EMA moving upward while at the same time low EMA will be moving downward. That happens when there is enlargement of the range, when the volatility picks up suddenly, and this is what we are going to try to take advantage of, because I feel that if there is a pickup in the volatility after subdued price action, that is going to be a time when large amount of money can be made in a short span of time, while avoiding to trade in times of subdued volatility. You will save on trading cost. So here I am going to give you a pretty novel idea of initiating the trades. What we are going to do is instead of going with the classical formulation, you can simply get involved for the trading when there is a pickup in the volatility. And for that, these simple kind of formulations like the EMA band expanding its range can be quite useful. And then you see on what side the volatility is expanding on balance, whether the price is in a declining phase or whether the price is in a rising phase. That can be considered, and then you can place your trades accordingly. So the condition that the EMA of the high price should be getting higher and the EMA of the low price should be lower can be incorporated into our system, and trades will happen only when there is sudden sharp moves on either side, that is going to result in the pickup in the volatility. Resultantly, the price band of the EMA will widen and create us the opportunity. After that, we can see on what side the price action is concentrating and go on to initiate the trade as and when we have favorable price action data. The simple condition like on which side the last candle is closing after this sharp move can be used as the initiation point. So the trading condition is going to be that there should be widening of this price band of the EMA. After that, we will look at the closing price of the last candle and then go on to initiate the trade. We will measure the difference between earlier EMAs, and then we will measure the difference between later EMA price band, and accordingly place the trade on whichever side the candle price is moving. Let me now look at this instant. But here the price volatility wasn't really enough to enhance the EMA price band. There was not much of an increase in the price band of the EMA. Let us search for other instance where this kind of thing happened, and we will have to, I think, go back in time and see where it might have happened again. Alright, here there was one instance. In it, you can see that EMA, lower EMA declined, while at the same time EMA of the high price went on to rise. This was also the instant where there was subdued price action followed by this sharp pickup in the price action. If you had gone on for this trade by using this methodology of lower EMA on the lower price being on the lower side, that is widening the price band, and then looking at the price data, you would have found it a bit difficult to trade here also, because in it what happened after this sharp move resultant resulting in the price band widening of the EMA, we had these big moves on either side. Only after a while these pricing stabilized, and we had this continuous move on the downside. So this kind of situation can also be sometimes there, which is going to be equally challenging to deal with, even with our new trading concept. Let us look at other instance. Here also EMA declined. The EMA of the low price declined slightly, only slightly, but at the same time EMA of the high price went on to rise. So what we can do, we can wait for a while after this widening happens, and maybe after a couple of candle periods we can initiate the trade after looking at these price data. That can also be done. Let us look at more examples of this kind of developments. Here also we had this rise in the EMA of the high price, while at the same time EMA of the low price went on to decline. Here also you see that after this subdued price action, the volatility picks up, and we can initiate the trade. Okay, we can add one more factor like ATR, the average true range, which will measure the average price range and then try to place the trades after taking into account the true range of the last couple of candle periods. That can also be done. So there are multiple ways in which you can deal with these kind of things. You can deal with the trend change, you can deal with the price volatility, you can deal with the range of the underlying instruments, recent price moves. All these things can be considered and incorporated into our trading system. And I am fairly confident that the methodology is going to be working to our advantage if we plan it well. Of course, not all the time. Trades initiated by it will be profitable, but we will definitely have higher probability of making money than losing money if we work with the system keeping in mind its advantages and disadvantages. So the system is going to be built on this EMA formulation, in which we will try to take advantage of the widening of the EMA price band with the sudden pickup, with the sudden sharp moves happening in the underlying instrument's price data in the recent times in comparison to its recent time series. And for the trend, we will see on which side the price action is concentrating after the initial spurt and go on to trade on that side only. Okay, so using the shift, we can go and place the increase in the price band couple of candle periods back, then set the condition for the initiation of the trade depending on which side the recent price action is concentrating on simple conditions like the closing of the last candle can be incorporated, and accordingly we can try to initiate the trade and take advantage of the pickup in the price data, in the price volatility. For this you are going to need simple EMA, not simple, I'm saying simply you are going to need EMA price blocks. You will have to take a couple of these, the EMA, then you will need to define these input parameters depending on which you will get the output. I think we are going to need four of these inputs to be modified. The default instrument, whatever instrument you want to work with, have to be selected for your trading algorithms default setup, whether you want to work with the Euro USD or whether you want to change and work with something else is absolutely fine and is being supported by the platform. You can choose from the wide array of the instruments. You can trade in the commodities, you can trade in the currencies, you can trade in the stocks, you can trade in the indices using the CFD, that is contract for difference methodology. And for that, all you have to do is change the instrument here, and your algorithm will work for the underlying instrument of your choice. Then the candle period, if you are a trader who wants to trade quite frequently, then lower time frames like minute, 5 minute, 10 minutes is going to be appropriate. If you take it a bit easy and want to initiate only couple of trades once in a while, then the time frames like day, weekly are going to be suitable. If you want to trade bit frequently, not multiple trades in a single day, but maybe couple of trades in a week, then I think the time frames like hourly, 4 hourly for the candle period are going to be useful. Shift, you can see this input value and define it for the price data's availability. If you want to incorporate current candles price data, then you have to keep the shift at 0. But if you want to take it back in time, like last candle period, then the shift of 1 or for that matter more will be needed, and it will push the price action data that many candle periods back in time. Then the calculation of the EMA for the given time period will be defined by this parameter, whether you want to work with the 14, that is the default setting, or want to change it to whatever suits your purpose, can be done here by incorporating this calculation period for your EMA. And with this, we will be wrapping up the session. When we come back again, we will add these EMA blocks and start defining the conditions for the trade. I think not only EMA, but we are going to need a couple of other indicators also for working fruitfully, for working the algorithm in which we are going to have high probability of getting it right. We will try to incorporate multiple things using multiple indicators which will complement our setup of the EMA. Now it's time for me to sign off for the day. I will be back again in the next session and we will continue our work. Till then, have a fabulous time ahead. Have a profitable day ahead, session ahead. the week ahead and the month ahead. See you next time around. Till then, goodbye.